interest rates seems, from my perspective, seems good because I can, take my money out of the stock market or whatever and put it into T-bills. And if T-bills are kicking off 15%, like I'm laughing, like that'd be amazing. Except for when you look across the entire economy, people have so much debt. The government has so much debt that when you try to service something with a raising interest rate, it gets gnarly really fast.
Think about this. So we have a $32.7 trillion national debt, which is rising by trillions of dollars a year. As of today, interest on the national debt is now the third biggest line item in the budget. So number one is Medicare, then Social Security, then interest on the debt, then national defense. We're actually spending more to pay interest on the money we borrowed than we're spending on defense. And of course, I think we're spending too much on defense. I think we should spend less, but we're spending more on interest. But here's the real problem. That number keeps growing. A couple of years ago, interest on the national debt was $300 billion a year. Now it's over $700 billion. By the end of the year, it'll be $1 trillion. By the end of next year, it'll be $2 trillion.
What?
In three or four years, the U.S. government will be paying more in interest on the national debt than it collects in taxes. So, I mean, this is impossible. Now, the only way around that is because the only way around that is if the Fed slashes interest rates. But what if they can't? What if they have to keep rates where they are? The government must default. There is no way that it can afford to make these payments because the Fed would have to print so much money to monetize that debt that it would create so much inflation that it would push interest rates even higher. Because the more inflation there is, the less private sector demand there is for government debt. But the more money the Fed prints to prevent interest rates from rising, the more inflation they create and the less attractive the government debt becomes. And now the Fed is the only buyer of treasuries. But now it's not just treasuries. What about municipal debt? What about all these municipalities and states that loaded up on debt? What's going to happen when it matures and they have to roll it over at much higher rates? What about all these corporations that borrowed a bunch of money to buy back their own stock? What's going to happen when that debt matures and now they have to try to refinance it and the rates have tripled or quadrupled for them? Everybody is going to collapse. Look, the problem is we need higher interest rates. Higher interest rates is what is part of the cure, but it's also what's going to kill the current economy. You can't get rates from where they are now to where they need to be without a collapse. It's like you can't make an omelet without breaking eggs. Well, we're going to break a hell of a lot of eggs because of how much debt we have. Why do we have so much debt? Because we had 20 years of artificially low interest rates, of punishing people who saved and rewarding people who borrowed. And so the whole economy is screwed up. We can't unscramble this egg. It's going to be bad. But I think that because it's going to be so bad, the Fed is going to choose what it perceives to be the lesser of the two evils. It will choose inflation over collapse, depression, financial crisis, bankruptcy. That's why I'm convinced that my portfolios are the correct approach. Just be in real assets, be out of the dollar, be in precious metals, be prepared to avoid the inflation tax because that's the tax that's going to clobber everybody.